Welcome, everyone. Today we're going to tackle a concept that, on the surface, might seem a little dry, a little technical: bond redemption. But I promise you, by the end of our time together, you'll see it for what it truly is: a powerful, strategic move a company can make. This isn't just about paying back debt. It's about how a company sends signals about its financial health, its confidence, and its entire game plan to the market.
So to make sure we build a really solid foundation, we're going to walk through this step by step. First, we'll nail down exactly what bond redemption is, the basic what. Then we'll get into the timing of it all, the when. And finally, the part that's most important for all of you as future decision makers, we'll dig into the why, the strategic reasons a company might pay back its bonds early. This way, we'll move from the mechanics right into the strategy.
Okay, let's start with Section 1 and define this core action. Before we can really analyze the strategy behind redeeming a bond, we absolutely have to have a crystal clear understanding of what's actually happening from an accounting perspective.
At its absolute core, bond redemption is simply paying back the principal on a loan. Now, the term you see here, face value, you'll also hear it called par value, is incredibly important. This is the amount printed right there on the bond certificate. It's the original amount the company promised to pay back when the bond matures. And let's be super clear here, this is not the same as the bond's market value. The market value is what that bond is trading for right now on the open market, and it can go up or down based on things like interest rates or how risky people think the company is. A bond with a $1,000 face value could be trading for $950 today or $1,050 tomorrow. But when it comes to redemption, we're talking about settling that original contractual $1,000 face value.
The IOU analogy, it's actually perfect. A bond is a formal, legally binding loan. When a company issues bonds, it's borrowing money from investors, and that shows up on its balance sheet as a long-term liability. In return for that loan, the company makes regular interest payments, which we call coupon payments. So the act of redemption is the grand finale. It's the moment that IOU gets torn up, the debt is officially paid off, and that liability vanishes from the company's books. And that has a real, tangible effect on the company's financial statements. It lowers their total liabilities, which in turn makes their debt-to-equity ratio look a whole lot better.
Okay, and this is where things get really interesting. This is where we shift gears from simple accounting to strategic corporate finance. Because, you see, the timing of this repayment isn't always set in stone. A lot of bonds have fine print that gives the company a choice, and it's right there, in that choice, that strategy comes into play.
And that brings us to the key question that you, as financial analysts, need to be asking. The timing here is not just a minor detail, it's a message. The answer to when tells you a ton about the company's financial situation, what its management thinks is coming down the pike, and their bigger corporate strategy. This decision leads us down two very different roads, each with its own story to tell.
So, we've got two basic paths. The first is redemption at maturity. This is the default setting, right? It's just business as usual. If a company issues a 20-year bond, they pay it back after 20 years. It's predictable, no big decisions needed. But the other path, the one that's way more interesting strategically, is redemption before maturity. This is an active, calculated choice. Now, a company can only do this if the bond has what's called a call feature, which makes it a callable bond. That feature, which is written into the original contract, gives the company the right, but not the obligation, to pay back the debt early. This means management has to sit down, run the numbers, and make a conscious call to pull the trigger on this.
I really want this point to sink in because it's absolutely crucial. Paying at maturity is just fulfilling an obligation. The due date shows up on the calendar, the payment goes out. It's passive. But paying before maturity, that's an active, strategic financial maneuver. It tells you that the CFO and their team have done a deep dive on interest rates, their cash situation, and what they need for the future. As you go forward in your careers, your job won't be to just notice that a bond was redeemed. Your job is to figure out the strategy behind that choice. What did management see that made them do it? So that brings us to our final and most strategic section. We have to ask the big question. Why on earth would a company, which is usually trying to hang on to its cash for things like R&D and growth, decide to pay back a huge loan ahead of schedule? Let's unpack the really powerful strategies behind this decision that might, at first, seem a little strange.
Just think about this from your own personal finance perspective for a second. If you have a really low-interest mortgage, you're probably not going to sell all your stocks to pay it off early, right? Cash gives you options, flexibility, the ability to jump on other opportunities. Well, the same logic applies to a corporation, just on a much, much bigger scale. So for a company to use a huge chunk of its capital to retire debt early, the reason has to be really, really good. Let's figure out what those reasons are.
Our analysis really points to two main strategic drivers for paying off bonds early. Let's start with the most common one, saving a boatload of money on interest. So let's paint a picture. Imagine a company issued some bonds 10 years ago when interest rates were, say, 7%. That was the going rate. But today, maybe the market has changed, or the company's credit score has improved, and now they can borrow new money for just 4%. Well, in that case, they're stuck paying a 7% interest rate that's way above the current market. By redeeming or calling those pricey 7% bonds, they can turn right around and issue new bonds at that lower 4% rate. We call this debt refinancing, and the savings can be massive, dropping right to the company's bottom line and boosting its profits. Now let's look at that second driver, restructuring their debt. This is a bit of a broader strategic goal. For example, a company might look at its balance sheet and think, you know what, we're too leveraged. We have too much debt compared to our equity. Investors and credit rating agencies can see that as risky. So, by redeeming bonds early, they wipe that debt off the books, their leverage ratios go down, and their credit rating might even get a bump, which, by the way, makes it cheaper for them to borrow money in the future. But another huge part of restructuring is getting out from under what we call restrictive covenants. These are rules in the original bond contract that can really tie a company's hands. A covenant might say the company can't take on any more debt, or can't sell a certain factory, or can't pay out big dividends to its stockholders. By paying off those bonds, management basically buys back its freedom, giving them the agility to make an acquisition, invest in a big new project, or reward their shareholders.
As you start to really build your skills in financial analysis, it is so important that you avoid these common traps. First, please get rid of the simple idea that all debt is bad. Debt is a critical tool for funding growth. The real question isn't whether it exists, but what it costs and how it's structured. Second, and this is probably the biggest mistake I see, is looking at an early redemption as just an accounting entry. It's not. It's a strategic signal. When you see this, it should be a trigger for you to dig deeper and ask why. And finally, like we talked about, never, ever confuse the redemption value, which is based on the bond's face value, with its constantly changing market value. A sharp analyst always understands these differences.
This quote right here really nails the main idea of our entire discussion today. An early bond redemption is not something that happens in a vacuum. It is a deliberate message to the entire market. It shouts confidence from the management team, it suggests they have strong cash flow, and it shows the company is actively managing its finances to build a more profitable and flexible future for itself.
So, as we wrap up, I want to leave you with this as a framework for your own analysis. The next time you're looking at a company's financials and you see they paid off debt early, don't just note it down as a fact. Ask yourself, what story is management telling us? Is this a sign they're expecting huge profits? Are they clearing the decks for a big acquisition? Or are they just trying to strengthen their balance sheet? Understanding this one action gives you a rare and powerful peek into the strategic thinking happening in the executive suite.